You would expect funds to flow into dollars, which are seen as safety. They're not. They're flowing out of dollars, not into euros. Well, I mean, there's a little bit on the margin. A bear closing maybe, euros, yen, sterling, and so on and so forth. But it's basically going into gold. I think it will spread from that into other commodities. We've had weak commodity prices recently. I think they've weakened too much. Silver has really caught a bid. That's been rushing up and has got a long way to go. I mean, looking at the moment, the gold-silver ratio is 84. It was 85.5 this morning. That should fall, I think, towards 70 and below, which tells me that silver is going to be a lot more powerful in its up move than gold.
The U.S. dollar index, a measure of the greenback's strength against a basket of major currencies, dipped below 101 in early European trading, marking a 0.3% decline. This weakness comes as the financial world eagerly anticipates monetary policy decisions from several central banks. Alasdair Macleod, a noted financial commentator, points to a worrying technical indicator for the dollar. The U.S. dollar has experienced a death cross in its trade-weighted index, Macleod explains. This bearish signal suggests that funds traditionally seeking refuge in the dollar during uncertain times are now pivoting towards gold and other commodities. Gold continues its impressive rally, building on substantial gains from late last week. The precious metal reached an all-time high of approximately $2,590 per ounce. This surge is reflected in the performance of popular gold-backed exchange-traded funds like GLD, which closely tracks spot gold prices. The rise in gold prices is primarily attributed to growing speculation about the U.S. Federal Reserve's next move. Market participants are increasingly betting on a substantial 50 basis point rate cut at the Fed's upcoming meeting, which typically boosts the appeal of non-yielding assets like gold. While gold captures headlines, silver is quietly outperforming its more famous cousin. Macleod notes that the gold-silver ratio has fallen from 85.5 to 84, with further declines likely. This indicates that silver may outperform gold in the coming months, he suggests. Indeed, silver prices have been on a winning streak since September 9th, trading around $31 per troy ounce during Monday's Asian session. Like gold, silver benefits from expectations of Fed rate cuts and overall dollar weakness. As the week unfolds, market participants will closely watch several vital events. The European Central Bank is set to release revised second-quarter labor cost data, while Eurostat will publish July trade balance figures. Various central bank monetary policy announcements are also scheduled. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
Well, on the supply and demand of physical, we know what's happening. Basically, the central banks are buying and the Asians are buying, and they're clearing out the market. Of particular importance is the Chinese consumer, who has a savings rate of roughly 35% of his income. That is huge. It's around about $6 trillion. The question is, where does that go? It's not going into property. It's not going into stocks. It's going into bank deposits. The rate on bank deposits is being reduced recently, so some of that on the margin is going into gold, and it's going into gold accounts at the banks. And it's the banks that are coming into London and effectively taking any loose bullion they can get their hands on. And so this has created something of a crisis within the paper markets, which we're seeing today. We have had a massive breakout on the upside for the gold price. The swaps, who are bullion bank trading desks, are caught short. I mean, roughly the contracts on COMEX, you've got around about 530,000 contracts. The swaps are the largest portion on the short side by a long chalk, and consequently they are being squeezed. And I would not be surprised to find that they turn tail and are forced to buy back those contracts in a rising market for gold prices, which could actually accelerate the price of gold very, very rapidly. But other than that, really, the thing that's driving it is principally loss of faith in fiat currencies, and particularly the dollar. If you look at the trade-weighted index for the dollar, that's got what the technical analysts call a death cross, which basically is a very, very bearish sign. We had the death cross a week or two ago. I think it's rather signaling that the dollar's trade weighted will fall from around about 101 at the moment, probably through the 100, and then the next stop is around about 90. This is a very major move down. And in very, very uncertain times, normally you would expect funds to flow into dollars, which are seen as safety. They're not. They're flowing out of dollars, not into euros. Well, I mean, there's a little bit on the margin, a bare closing maybe, euros, yen, sterling, and so on and so forth. But it's basically going into gold. And I think it will spread from that into other commodities. We've had weak commodity prices recently. I think they've weakened too much. Silver has really caught a bid. That's been rushing up and has got a long way to go. I mean, looking at the moment, the gold-silver ratio is 84. It was 85.5 this morning. That should fall, I think, towards 70 and below, which tells me that silver is going to be a lot more powerful in its up move than gold. But it's being driven by gold. So the whole thing has got a developing air of crisis in the markets, I think. And I would go back to what I was saying about Warren Buffett's position. I mean, if you look at the inflation outlook, interest should not fall. They should actually be rising. But the problem is that the underlying economy, US economy, is not performing well. And I don't know whether you noticed this, I think it was yesterday, the budget deficit for August was released, and that was about $380 billion, about twice the level which it was during the COVID crisis, when, there was no income coming into the government and accelerated payments out. I mean, this is a very nasty shock, and it tells me that the US economy has run into a brick wall.
As the world looks ahead to 2024, the BRICS alliance is poised for a transformative year. Its upcoming summit is expected to set the stage for significant developments in global finance and trade. While speculation runs rampant, experts watch for potential announcements that could reshape the international monetary landscape. One of the most anticipated developments is possibly the unveiling of the Brics pay system. This blockchain-based payment platform could establish a new standard for trade settlement among emerging economies, potentially challenging the dominance of existing systems. Introducing such a system would significantly promote greater financial autonomy for the BRICS nations and their allies in the global south. Amid technological advancements, a recent price surge has renewed attention to gold's role in a potential BRICS currency. This has reignited discussions about its potential in global de-dollarization efforts, though the idea of a native BRICS currency has not been at the forefront of the alliance's agenda. Alasdair Macleod suggests a simple approach to a gold standard. A currency should be freely exchangeable for gold at the central bank. This idea could form the basis of a stable alternative to the current dollar-dominated system. Let's get back to the interview.
There is an assumption in certain quarters that there will be a new currency on the agenda at Kazan, which is the October summit for BRICS. I don't think there will be. There may be some mention of it on the basis that, an update of planning and so on and so forth. But what people have latched onto is a proposal for a new currency, which was called the unit. Now, this currency was the paper on it was produced jointly by a Russian and a Chinese individual. But when you look into the background of these people, they are actually private sector investment managers. This is not, a joint government, Russian Sino operation at all, which the names you would think suggest it is. No, it's not at all. And furthermore, it is quite clear that the authors of this unit paper really don't understand credit. They don't understand the relationship between money and credit. They have recommended a backing of 40% gold and 60% currencies, which are valued on a day-to-day basis in terms of gold, and the whole thing put on some sort of blockchain. There is this tendency, I think, to overcomplicate really what essentially is a very, very simple relationship. The way a gold standard works is really extremely simple. A currency must be freely exchangeable, either in terms of cash or in terms of bank deposits for gold at the central bank. It's actually as simple as that. And it's easy to put in too. And it's easy. We do know how to manage gold reserves. You do that by using the interest rate to manage the gold reserves. You do not use interest rates to try and manage economic outcomes. That is a huge, great mistake. As we've seen, I mean, time and time again, interest rate policy has achieved absolutely nothing. If anything, it's probably made things worse. So it's all about having sufficient gold reserves in the background to give confidence to people that they don't need to cash in their dollars or rubles or whatever it might be for gold. And that is maintained by the issue department actually having control over interest rates. I mean, there are various other aspects of this, but they are relatively simple. And I wrote a paper on this for my Substack readers, which came out yesterday. Yes, yesterday. So I think that the whole of this trade settlement currency thing has been blown up unnecessarily. And in fact, it's actually very easy for Russia and China, perhaps, to deal with this. I mean, if they were minded to do so, they would say, take 100 tons, and they wouldn't need more than that. Probably even 50 tons would do it, of bullion to back a new trade settlement currency, which you could call anything you like. I mean, you can call it the unit if you want. But the point is that the currency is credit, and it is anchored to gold. So it have to be readily realizable in gold in order to give it its credibility. Just, it's very, very easy to set something like this up and then say to, Brics or SCO members or whatever, if you want to use it, it is there. If you don't want to use it, that's your choice. I mean, it's really as simple as that.
As the global financial landscape evolves, the interplay between emerging Brics initiatives and the resurgence of precious metals paints a complex picture of potential change. The possibility of new payment systems and gold-backed currencies challenges the status quo, raising questions about the future of international trade and monetary policy. With central banks poised to make crucial decisions, investors and policymakers alike must remain vigilant to the shifting tides of global finance. Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.